Friends, in the previous part 1, we were discussing on credit risk, how it can be mitigated, what is actually the significance of credit risk, what are the steps to be initiated to prevent the credit risk, and also we have discussed how the credit risk can be managed. Now, there are certain guidelines by RBI which are to be meticulously complied with so far as credit management is concerned. What are they? We will be going to discuss RBI guidelines on credit management. That would be our topic. So far as this part 2, we will be discussing on the RBI guidelines on the credit management. Okay, RBI has already been circulated these guidelines because that is it's a very severe problem so far as the credit risk is concerned in the banks. Severe problem so far as the banks are concerned in lending that credit risk. Okay, the first RBI says that RBI guidelines provides that as far as possible, the appraisal, I told you because at the time of the management we said appraisal is the foremost one. Appraisal, and bank should carry out the appraisal as far as possible independently, and outside or in-house sources of the borrower need not be relied upon. So bank should consider independent appraisal so that bank can have a correct view on the appraisal. Correct assessment can be made, and thereby to prevent the credit risk so far as lending is concerned. So independent and objective credit appraisal. It is not only independent. That appraisal should be that is objective to the, because our bank's role is there to give the need-based credit. So the bank should consider as far as possible and or avoid hiring the outside consultants. There is no ban on outside consultants. In many cases, banks are relying on the outside consultants, but as far as possible, banks should carry out independent and objective credit appraisal while doing this lending activities. And so far as lending activities, any type of activities, okay, any type of lending activities, okay, and avoid dependence on the external consultants for credit appraisal. As far as possible, avoid the external consultants for this credit appraisal, because that is, when we discuss about the consultants, we will always remember that the external consultants' effort should be how to get the adequate finance to how to get the required finance, or the finance, how much is there. They are fixing the this much finance will to be sought from the bank. So he will always see, the consultant will always see that how best he can get the facility from the bank. Thereby, he may get his commission also accordingly. Whatever remuneration, whatever commission he is fixing, that he will get it. But here, his assessment is way of computation, everything would be different. But as a lender, as a banker, we have to go from the grassroots to the need to assess the need-based requirement of the particular unit, for which independent assessment should be needed or inevitable. For infrastructure project, again, the project banks, lenders should carry out sensitive tests, and it is a duty of the lender or the bankers to carry out the sensitive test or scenario analysis. Sensitive test or scenario analysis. When we talk about sensitive test, any change, upward or downward, change in any of the variables. So far as if a manufacturing unit, so suppose any raw material cost is going up, little bit gone up, then what would be the impact on finally on the bank's profitability, bank's ratios, banks, DSCR, all the things to be carried out. That is sensitivity. Whether the particular any change in any of the components will have whether the unit is sensitive to that change, whether it is upward or downward, whether it is sensitive. That is a sensitive test is being carried out. That not only for the infrastructure project, even it is advisable for other type of larger exposure also. Then scenario analysis. Yes, so far as infrastructure is concerned, scenario analysis is another area. That is depending upon the various scenario, in the sense project delays and cost overruns. That is scenario. Delay ho jata, that is another one type of scenario, and cost overruns. In that case, what would be the effect on the parameters and how the unit will react to that. Unit in the so far as generation of income and repayment or servicing of the debt and its obligations, how that will react. That is what another this one. That any abnormal things, any not so good symptoms of any sickness or anything comes, or any we can say that stress nature. So immediately bank can consider, the lender can consider, so for a suitable corrective action plan. Corrective, then CAP, corrective action plan can be initiated with a suitable restructuring, so that account should not be drifted to NPA. So corrective action plan is another area where they can take a suitable step. So that is what the guidelines RBI says. The bank should independently should go for the corrective action plan, thereby the account can be revived in case of any problem that is arising due to either these accruals or any other internal or external factors, any changes taking place, any negative impact taking place. So that should be arrested and go for corrective action plan. Then again, in the bigger projects, the infrastructure project and all, it is bank's duty from where this capital is brought in. It should not, the capital is brought in by the promoters or the shareholders. It should not be from the by converting the debt of the parent unit into as a capital here. No, it should be source should be ascertained from where, because otherwise the later part it will affect the financial position of the unit itself. So there is a sort of camouflaging the financials, or financial jugglery is taking place. That should be avoided. So the lender should always see that the source from which the promoter, the capital has been raised by the promoters as well as the shareholders. Then another area to be seen is that always, in order to avoid any other problems in the future, while considering this, by processing this, processing the proposal itself, or while processing the credit proposal, the introduction of the director identification number, we can say that DIN, director identification number, because there are a lot of instances have come to brought to the notice of the RBI with a similar name. Many units have denied credit facilities from the financial institutions because similar names are coming. So it is always see that for want of names are common. Many places these similar names are coming, similar surnames are coming. So sometimes address also may be, by and large, it may be same. So such things, so they should, for want of the clarity, the person or the unit should not be denied or deprived of his right to get a legitimate credit requirement. So it has been stipulated that while processing itself, identification number, DIN, director's identification number should properly be recorded, and that should be taken so that should be taken it forward, so that such kind of instances, that is denying the credit facilities to another unit wherein similar name has come should not be occurred. Then here also another step is that list of defaulters, willful defaulters, by verifying this directed identification number, that is also required. The defaulter, then there is normally banks would not consider extend any credit facility. It's already a defaulter, and here whether it is really a defaulter or not, it's a common name that will not be sufficient. So the list should be there, the list of defaulters, willful defaulters, by verifying this DIN as well as PAN, permanent account number. These two things verify, both are matching. In that case only the conclusion can be made whether it's a willful defaulter, whether it's a defaulter. So list of defaulters and everything. So banks at the time of processing, bank should ensure that this director's identification number is there, and in addition, that is just to avoid any hardship to the genuine parties, because genuine parties due to the common name. And in other cases, to the bank's own interest, to see that that particular unit, the promoters are not coming under the defaulters list, or particular unit is not coming in the defaulter list or willful defaulter. So that is to be properly checked into. These are the broad guidelines. Then it is also the duty of the lender to see the end use of the fund. The assets created out of the bank finance should be there, whether the proponent, whether the borrower has properly utilized the bank's finance for raising or by creating the asset which is already envisaged in the credit. So any diversion has taken place or not. For that, there is always a covenant in the agreement. It should be made in the saying that the proper certification by the auditor of the borrower may be insisted. Now, in addition, RBI says that okay, fine, bank can insist for the certification by the auditor of the concern. That can be, and proper covenant should be made in the main agreement itself, that what are the conditions to be complied with the auditor when he gives the certification. That is also there. So these two things to be complied with, and there also, instead of depending on the in-house auditor or the outside auditor or a consultant for getting the certification, banks can also engage their own auditors, their own qualified people to get this certification done, so that they will have the complacency. That in the sense that they will satisfy, instead of depending on an external party, by the in-house auditor of the borrower or an external party. There, if bank can engage, bank can utilize their own infrastructure to get it certified, then that is the best way of doing it. And there is no ban so far as certification by the borrower's auditors. But as far as possible, that also can be avoided. Instead, as in the case of appraisal, as I explained in the part 1, that bank should have independent this one. Here also, as far as possible, the lending bank should have an independent certification to satisfy the genuineness of the certification given by the auditor. Or lender can also cross-check the certification given by the borrower's auditors. Okay. Then another one is registration with the CIRSAI. CIRSAI registration now, earlier it was only applicable for the equitable mortgage. Now with the amendment to the section 23, 24 and 25 of the SARFAESI Act, the CIRSAI, almost all the charges are to be invariably registered with the CIRSAI. The charges, when I say, the charges include equitable mortgage, that is there. Earlier it was only equitable mortgage. Equitable mortgages are there. Then any other type of mortgage created, any other type of mortgages created in favor of the financial institution or the bank, that should be registered. Then all any hypothecation charge, that should be registered. Even hypothecation charge on the movable to be registered. Then charge on the movable in the sense stock, inventory, as well as receivable to be registered with the CIRSI. Then even for charge created in favor of the institution on intangible asset. Intangible assets also. This is, you may perhaps remember that some of the incidents recently it has come in the press, in the media, that one of the banks financed a huge sum against the goodwill of a particular company, and the bank has burned the finger. So that is perhaps that may be the reason this amendment has taken place, wherein it was stipulated that even a charge on the intangibles also should be registered. Then charge on even partly constructed buildings also, partly constructed construction also to be registered with CIRSI. In all, most of the charge, any charge created in favor other than pledge there is no need, because pledge is in the possession of the lender. So other than pledge is to be registered, invariably it should be registered with CIRSI. And for enforcement, it is a must. That says CIRSI's registration is a must so far as enforcement is concerned. So bank lenders should be very much careful about this one. Then board oversight. Ultimately, in a bank, in every bank, the board is the supreme authority, apex authority here. And periodical appraisal to the board about the quality of the asset should be made by the respective departments. The board should have should be aware of all these things. And we can also say that board awareness of the things, board can also take suitable steps based on the reporting. Then suitable duly approved board policy should be there. That policy will encompasses means so many conditions, so many means precautions to be taken by the branches, by the controlling officers while undertaking this credit proposals. The timely submission of the information to CRELAC in the sense credit risk, credit center repository of information on large credit, CRELAC, CRILC, Central Repository of Information on Large Credit. So timely submission of credit information to CRELAC. Similarly, timely submission of the credit information to credit information companies. Then any symptom or any symptom of sickness, industrial sickness, anything is noticed by the board or otherwise, other people also, others branches or controlling officers, then they should immediately consider evolving suitable resolution plan. That is RP, resolution plan should be evolved as soon as there is a default. Then resolution of stressed asset, including timeliness of resolution. As per the IBC, we have seen that any resolution plan should be completed and implementation should be taken place within 180 days. In exceptional cases only 90 days can be extended, provided the creditors will agree for that. The resolution should be there. Initiation of the suitable steps. Then based on the resolution, whether if the viable unit, go for the revival or restructuring, and for non-viable, going for the liquidation. For that, reference is to be made. Here, as I told you in the morning session, that the cutoff limit, any default beyond 2,000 crores should be reported to reported for industrial means IBC, Insolvency and Bankruptcy Court, for implementation, for examination of the IBC, whether to go in for revival, whether to go in for liquidation. A resolution plan is to be framed or not. Even other less than that one, as I told you, that is CAP, that's corrective action plan should be initiated by the respective banks. Then once this amount exceeds, the default exceeds 2,000 crore, it is mandatory. So far as all the banks are concerned, they should file this before the NCLC or refer to the IBC and yes, Insolvency Bankruptcy Court. That should be within the 15 days of the symptom of insolvency. Filing, once you default is taken place and default exceed 2,000 crore, that should be within 15 days of that notice should be filed for before the IBC. Then the policy also should contain, considering the importance of the credit risk, the policy also contain the provision for appointment of the credit risk officer. All the banks, every bank should have a credit risk officer, and it should be for a fixed tenure. Either it may be for 3 years, it may be for 2 years, 1 year, or 5 years, or 10 years, as the case may be. The credit risk officer should be appointed, and he should not. The officer should be in the bank's senior hierarchy. He should be in the senior hierarchy and independent charge. He should not be involved in any other operational activities. That is a condition by RBI. The reporting and that credit risk officer, CRO, we can call it as credit risk officer, should be reporting directly to the managing director or direct to the CEO, chief executive officer, or risk management committee of the board. He need not approach, he need not report to any other functional department except these 3 areas. Either it should be MD, managing director, or the chief executive officer, or the risk management committee of the board. It's as good as the board. No reporting resolution, no reporting responsibility so far as the CRO is concerned. And CRO should not be given any target, business target, because he is an independent body, independent authority, looking after only on the risk aspect. So he should not be involved. He should not be burdened with any other thing. His duty is exclusively different than that of the other functional departments. No business area. CRO is associated with, in case of need, sometimes the banks, if at all involving some credit proposal also, CRO is associated with the credit sanction process. Whether then it should be seen that RBI said you can only act as an advisor in case, that too very exceptional cases. But he should be act as an advisor, not as a decision maker. Decision maker nahi. He should be only as an advisor. This department wants some advice, then only he can be involved. Then committee approach, high value proposals. Banks are having either credit grid or credit risk committee, CREC, credit risk evaluation committee, like that. Different nomenclature has been given by different banks, but this approach should be there. That is group committee approach in larger exposure proposals. Not following committee approach for sanction of high value credit. If that particular bank is not complying with that's RBI guidelines are there. So far as committee approach, if that is not there, the the CRO can only be an advisor in that sanction process. If that committee is not there, either the credit grid or the credit risk evaluation committee, wherever it is not there, it is mandatory so far as the banks are concerned. In case any bank doesn't have such a setup, in that case where the CRO, that permission is there, the CRO can act only as an advisor, not as a decision maker. The CRO in his role as an advisor shall be, and you can also invite to the credit sanction. He is only an invitee, and approval, invite credit sanction, approval committee without any voting rights in the proceedings of the committee. Because any committee that voting rights are there, various executives would be sitting and they would be passing it. Yes or no, because majority will be taken care of. In that case, here the CRO's role should be, the guidelines are there, CRO should be only act as an advisor, not as a decision maker. No role in so far as proposals are concerned, credit proposals are concerned. and there shall not be any dual hatting. As I told you in the beginning also, dual hatting means say that CRO for a particular this one department, CRO for CEO for particular department, CEO for this one. No, it's only is exclusively in charge of the credit risk section, credit risk officer, that is CRO. No other role is to be assigned, and exigency is only permitted when there is the bank is not having a setup of committee arrangement, committee setup for credit decisions. In that case, he can act as an advisor, not as a decision maker. With this, we are concluding this session. So we have discussed the credit management in the nutshell. What is credit management, and what are the steps to be taken to manage it? That is preventive as well as that is a credit management, and what way the credit management can be taken place. Then what are RBI guidelines? RBI guidelines also various guidelines, various points, guidelines have been discussed within the available time. And also RBI also has even emphasized on the banks to